Hey folks, Spencer here again. Given that interest rates have risen significantly in the last quarter, what I want to do is walk through an overview of how interest rate movements impact bond prices. So Austin and I are going to tag team on this together. The big picture is, even though interest rates have moved up, bond prices have moved down, for long-term investors, it shouldn't make a big difference in outcomes. And we'll get into the rationale of why that will be. But again, the headline is that if interest rates move up, bond prices move down for a season. So if you're looking at your statement and interest rates have moved up, you might say, oh, I thought my statement would be a little bit more. I thought my bonds would hold their value a little bit more. They've dropped some. The flip side would be if interest rates fall, you may look at your statement and say, goodness, my bonds have increased in value. And of course, the last outcome would be, if interest rates don't move around much, you may see a modest gain in your portfolio overall. So with that as an overview, what we'll do is turn things over to Austin, who will walk through a visual, and then we'll come back and walk through a couple of examples of how interest rate movements would impact the price of bonds and over maybe a 10-year rate of return sequence.
Okay, let's take a look at how bond interest rates affect prices visually. So if I have a bond that I've bought for $1,000 and it's a 10-year bond and it has a 2.5% interest rate. What that means is that I get $25 a year paid to me from that bond as an interest payment, and at the end of 10 years, they're going to pay me $1,000. So the price and the interest rate haven't changed because the bond stays at the same rate the whole time. Now, what happens if our interest rates move? Let's say that same bond that I own, interest rates are going to decrease. So the interest rate in the market right now, let's say, is 1.5%. So we've seen interest rates go down, which means prices go up. So if I own this bond and Spencer wants to buy it, because if he goes to the market right now and wants to buy a 10-year bond, well, it's only going to pay him $15 a year, not $25. So because I can get more from my $25 payment, that means Spencer would be willing to pay $1,092.54 for this bond. Because I'm getting a higher interest payment every year, Spencer is willing to pay more money for my bond. Now, what happens when interest rates rise? Well, when interest rates rise, we've got that same bond that I own, but now it goes down. So here's my price. It's gone down because the interest rate has gone up. Let's say it goes up to 3%. Well, now if Spencer wants to buy my bond, he doesn't want to pay the full price because he can get a $30 interest payment every year versus my $25 interest payment. So the price of my bond now goes to $957.08.
So what we'll do in this first example is we'll take a hypothetical yield to maturity, a hypothetical interest rate that a 10-year U.S. Treasury bond will start at. Now, right now, as I'm talking, it's at about 2.7%. But we're going to round that and make it a little bit easier conceptually as we move through this example. So let's just say that in a few months you bought a 10-year U.S. Treasury bond, and then it was paying 3% interest each year at that time. Now, when you look at your statement from year to year or from quarter to quarter, that value is going to change of the bond based on interest rates. And the value of the bond is going to be priced on a day-to-day basis. It's just giving you an idea of what you would be able to get for that bond if you went to the market and you tried to sell it that particular day. Now, for most of our long-term investors, we're very selective about how we think about which bonds to sell or which mutual funds to sell. But on a day-to-day basis, you can sell that bond. So the statement is going to be a reflection of what that bond is worth. Now, if you're going to hold it for the 10 years, then your income will be the same over that period of time each year. So let's think about what the statement might look like on a year-to-year basis if we were just taking it as a snapshot. Again, if it's a 3% interest rate and you have a $1,000 investment, what you would have is a payment of $30 every year. So in that first year, you have income or interest of $30 being paid to you, but because in this example, the yield to maturity, the interest rate overall for competing bonds drops to 2.5%, the price of that bond goes up. And you can see the bond price there is $1,039.85 in this hypothetical example. So your statement would show, wow, you've had a rate of return that is the interest plus the capital gain there for a total of a rate of return of just about 7%. So let's extend this one more year and say that interest rates drop again. You could see in that example, interest rates go from 2.5% down to 2%. Well, that's again pushing the bond price up. It goes from $1,039 up to $1,073. And so your rate of return there, you get $30 of interest again, and then the capital gain goes up another $33. So your rate of return, big picture, is over 6% that year. Now, let's say that the opposite happens the following year. Interest rates go from 2% back up to 2.5%. Well, that creates a headwind for the bonds as we look at their prices. So the price of the bonds that bond goes from $1,073 down to $1,031. So even though you get $30 of interest, because the price dropped by $41, you have a rate of return of -1% in aggregate. So you can see how that continues so on and so forth in years where interest rates drop. You can see the bond price move up, and in years where interest rates increase, those bond prices drop. So those rates of return, they're seldom going to be right at the interest rate. They're going to be driven in some measure by the interest that's paid, but also the capital gain or loss in a particular quarter or in a particular year in this example. The second example that I have right there is an example where we say, well, what if you bought the bond and then overnight interest rates moved up substantially? So what if you bought the bond and it was 2.5% interest at the start? That's going to give you $25 for every $1,000 bond on an annual basis. But what if that interest rate moved from 2.5% all the way up to 4%? So it increases 1.5% overnight. Well, what you'd find is that in that first year, the price movement would drop by about 11%. And that 2.5% rate of return wouldn't catch you up, wouldn't get you back to zero. So the overall drop would be 8.65% in this hypothetical example. But what you'd find going forward, if interest rates stayed the same, if they stayed at 4% for the next 9 years, is that your rate of return that you receive on the statement again would be right at 4%. So it's counterintuitive in this manner, but if you have an interest rate increase, you will be able to reinvest those interest payments at a higher rate, and rising interest rate environments tend to be good over a long time for bond investors because it just means that we're going to be able to reinvest our dividends, reinvest our interest income at a higher clip going forward, and should lead to better rates of return long term. But again, in the short term, we've seen that price drop. So if you have any questions, as always, don't hesitate to reach out to us. Again, it's our mission to bring confidence and rest to your financial lives. Thanks so much.
We hope that you enjoyed this video presented by Retirement Planning Services. We are in Knoxville, Tennessee, and you can find us at www.seriousretirement.com. Our mission is to bring confidence and rest to your financial life so you can focus on the people, causes, and activities that give you energy and life. Advisory services are offered through Retirement Planning Services, LLC. All examples are hypothetical and for illustrative purposes only. Actual results will vary. No part of this presentation is intended to make an offer of sale or purchase of any specific security or insurance product, nor to offer accounting, tax, nor legal advice. Past performance does not indicate future results. Indices are unmanaged and cannot be invested into directly. Thanks for watching, and we hope you have a great day.